and internationally in various aspects of mine geology, exploration, project management, and strategic leadership in the gold industry, and he's Managing Director of Prodigy Gold.
Are we on? So, gents, do you want to briefly introduce who you are and your background quickly? Grant?
Sure, looking at me. Can you hear me? Grant Nicholas, Director of Natural Resources for Western Australia based in Perth. Between myself and another director, we've got accountability for all the oil and gas and mining and metals for Western Australia.
Kevin Jamieson, Director from National Australia Bank, based here in Perth. A bit of a simple story, really. We have two directors based here in Perth, and we split the portfolio between us for mining companies. And I've been a banker essentially with NAB for about 7 years, and before that, BNP Paribas for about 24 years. So been a banker essentially my entire career.
Thanks. My name's Paul Early. I'm a co-head of Barclays in Australia. I also have another role being head of natural resources for the region for Barclays. I've also been involved with natural resources for a very long time. In fact, Kevin and I have known each other for a very long time. And prior to Barclays, I was at Rothschild, also covering natural resources, but so very much across the scene as well.
So we just heard from Nigel there's increasing interest in lenders and investors into the strategies and policies of the mining companies. Grant, do you want to kick us off? What do you think is driving that interest in those strategies and policies?
Yeah, look, I think it's a good question, and I think Nigel actually introduced a lot of the legalities and some of the regulatory structures in terms of compliance and the Paris Agreement, etc. Basically, for ANZ, our investors and our shareholders want to understand how we are addressing and how we're being held accountable for climate control risks and what we're doing in terms of understanding our risk profile. So many of our clients, obviously, whether it be mining related or whether it be in the transport area or whether it be in building or construction, are emitting or responsible for carbon emissions. And as a result, our shareholders and our investors want to understand how we're addressing those risks and what our action plans are to adhere to that. So hence it's something that we focus on quite intently.
Yeah, I think too, increasingly the financial regulators are focusing that across all industries and also banks. So what does that mean? That means that banks need to understand what the clients are doing, because we need to sort of do our own stress testing as well, and we come under scrutiny from regulators, and that I think that will be increasing over time, and also investors.
So you're seeing that jumping onto your own company risk matrices of a threat for the future is further scrutiny by the investors and the regulators?
Yes, certainly. I think the process, as I said, I've been a banker for 30 years, and certainly over the last 10 years, you see the processes within environmental and social governance teams within banks and their role increasing, and that's a result of more scrutiny, and certainly there'll be more regulation and governance, and they'll become more formalised over time. So it's a process which for us, when we're onboarding a new client and when we're doing annual credit reviews, we also need to take into account environmental and social governance criteria as part of that onboarding, and also just the regular process of reviewing the credit.
So Paul, what sort of conversations does your company have with the management teams through that onboarding and investment process to drive that?
Yeah, generally as Kevin said, I think the drive of it has been driven from not only the boards, like from top down, like Grant was talking about before as well, Nigel was talking about before as well, but in our case it's the regulators as well. So the actual regulators that regulate the bank want to see what the bank's doing on that. Then you have the shareholders putting that pressure on as well. So that all filters through the system, and then we have to onboard a new client, or we have to talk about doing a new transaction to someone who, in the mining sector and the oil and gas sector, we have to tick certain boxes to make sure that they're doing the right thing from the environmental, or minimising their impact to the environment in the ways that they're generally doing. So whether it's BHP or in terms of their policies on environment or policies on carbon pricing, those things all count for when we're assessing, what we're doing with those sorts of companies. And as Kevin said, it's certainly changed a lot over the last 25 years. Before, it was just really determining whether they were complying with laws, but, it's gone beyond that now to, fairly active. And those companies themselves have shareholder groups that are pushing their agenda with those companies as well. You saw the publicity around Norwegian pension fund, for example, driving the fact that they're not going to be investing in fossil fuel companies. And they're a pretty big player in the investment market. So it gets driven on all fronts but it does filter down to us when we're, putting up assessments that we have to tick those boxes and make sure that the companies are doing the right thing.
So what sort of things are the investors looking for? Is it specific policies or management plans, or is it targets or metrics that people are measuring against? What are you hearing most commonly?
Well, I think it's all of the above, effectively. I guess if you take a step back and look at it from the bank's perspective, we have to, stress test our own portfolios for ESG matters and climate change. To do that means we need to understand clients' strategy, what they're doing, how they report it, what their plans are, and then that all feeds back up to how we stress test and how we look at ESG risk for our customers. So it's basically all the above.
If I can add to that as well, I think it is an absolutely a robust process, and robust in the sense that, I guess, it's been touched on, but we would want to understand the physical risks that our clients are exposed to. Physical in terms of climate control risk, whether it's a storm or a climate event. And it could be a shipping company or it could be a mining company that's may not be able to export its goods through a certain port because there's a storm event, for example. But in addition to that, it's also got the transitional events. What are they doing to adjust and to evolve to a lower carbon environment? And to that extent, it could be saying, hey, some of their suppliers could be guys that are supplying energy, but it could be from coal-fired power stations. What are you doing in order to understand, mitigate those risks and understand how that impacts upon your business profile? And so that all forms part of the overall, I guess, the credit risk assessment. But then also there's the other side of it, which is the risk side is one thing to understand the potential impacts, but then also about what's the upside. The upside is how do you look at funding some of these new developments and these new sustainable opportunities. So I guess that's the whole approach that when we liaise with our shareholders and with our investors, and we report them publicly, and there was a question earlier to Nigel about the TCFD, that's the Financial Sustainable Board's Task Force for Climate-Related Financial Disclosures. That's a mouthful. But what it really means is that for us as a bank, we've adhered to that disclosure. It's quite a diligent process, and what they ask is identify those risks that we as a bank are exposed to, and that's obviously a function of our clients that we bank. And then it's the governance related to that. What governance mechanisms, what's accounting, etc. Who's accountable for that? What are the interface plans that you have in order to achieve a lower carbon environment? And then how do you disclose that? So, yeah, it's not one metric, it's certainly, I guess, all of that.
And actually, you raise a good point too, and that is, I was sort of focusing on the credit risk piece, but also it's sort of seeing where new opportunities are too. So there are companies that are developing renewables as part of their energy strategy. It's how to fund those. There are new products like what's it called, green bonds, which are linked to companies meeting certain sustainable targets or reducing greenhouse gases, and then over time, those companies can benefit from a price reduction. And it's also something then that with those bonds, there are investors into those bonds that would otherwise not invest in those companies if it was not for that sort of green halo, that green halo sort of piece that's attached to that financing.
So there's a lot of different companies or mining companies and investment companies involved. Is there adequate consistency in the definition and standardisation of reporting yet, or is that somewhere that needs to be improved, and can you see any movement down that path? Paul?
I think companies are kind of, if you're not, even though companies are ahead of themselves, they're actually addressing things before legislation gets passed and before standards get improved. I think a standardised system would make it simpler. And if you're going to if you're going to actually properly price things in the system, everything has to be sort of relatively standardised so you get the pricing right and people can't arbitrage the system. But at the moment, I think that it's not quite as standardised as what it can be. But it's moving that way pretty fast, and I think it'll get there from my perspective.
Yeah, I think that's right. I think at the moment there's a lot of people that are working on ways to try to standardise the reporting, and we definitely have to have that, because that then provides certainty for mining companies and all companies, but also for investors. They're able to benchmark basically against standardised reporting, so they're able to review like for like. So now it's a signatory to the Carbon Disclosure Project, and that goes out to listed companies each year. And we look at things like their own ESG assessments, their annual reports, the sustainability reports, and so forth. And I think it is creeping in there that over time there'll certainly be a standardisation of how this is evaluated, reviewed, and reported.
If I could just add to that, I think that I mentioned previously ANZ adheres and complies with the reporting disclosure requirements for the TCFD. I understand there's about 14 mining companies that already are doing that. That includes Anglo American, BHP, Rio Tinto, etc. So I think, as the guys have said, having a standard at least presents something where you can create a measure. And I guess if you use that as an analogy compared to the mining industry, maybe a decade ago for gold, where you didn't have a standardization on all-in sustaining costs. It was kind of all over the place, and arguably there's still a little bit of movement in there, but it's far clearer and it's far more transparent for shareholders and maybe less sophisticated people who don't always have the insight and have an ability to understand how one company can be compared to another. And I think that's where the TCFD compliance and reporting disclosure is going.
So starting to see that transparency coming in, are you seeing a change to the style of investment analysis that's been undertaken, and do you internally have you seen a shift in the way that you're doing that modelling?
I think definitely. I mean, you don't get too many brownie points for putting up a facility or doing credit to something that could be more fossil fuel or mining intensive. If you're putting up a solar farm or something internally or doing a green bond, it certainly gets a lot more attention, in terms of what we want to market as what we're doing. So I think that sort of just is a natural flow through. I think it's pretty interesting, particularly for mining and oil and gas, because these two businesses are the most, carbon emitters. They're actually the fundamental nature of what the company's doing. And, certainly, we've all sort of had the pressure within those sectors, I guess, in terms of thermal coal in particular, as being one where, it's certainly a lot tougher for any of us to do anything around that sector in particular, being one of the most, as Nigel said, 2 tonnes for every 1 tonne pulled out of the ground. So it's certainly it's influencing things.
Paul mentioned the C word, so I may just take on that. Look, I think we've been public about our ability to fund fossil fuels, and in terms of, with regards to coal, if we look at what our incentivization is from our investors and shareholders, that's certainly where they want us to reduce our exposure on a total basis. We've gone from $2.3 billion exposure in 2015 to about $1.5 billion as of today, and of that, I think about 944 million is thermal coal. So we've been public that the intention is to reduce that exposure and focus on more renewable style projects, which is what our investors and shareholders would want. And I think also it does absolutely, to Paul's point, if with every credit submission that you put forward for funding, it gets scrutinized a lot more intently right now. And that's important for I guess anyone looking for funding, or even people that have existing facilities and talking about refinancing. If increasing limits for markets purposes or for whatever the case may be, that will be looked more intently by the banks, because the banks are being measured as well, and by our shareholders, our investors, and we're trying to comply with various regulatory bodies that are measuring us.
So, the ability to make those submissions for your investment, are there any companies that you think are leading the way in their transparency that allows you to more readily put those submissions forward? Or if you can't say the companies, is there anything that a company has done or a strategy that they've had that has assisted in putting those funding approvals forward?
Well, I think interestingly, if you kind of just look at this conference, and I was here last year, and South32, with one of its mines, had integrated as part of its renewal of its energy requirements, that it integrated solar into one of its remote mines. There was Goldfields yesterday talking about how they've integrated renewables thanks. So there are plenty of instances where we see a lot of listed companies that are basically undertaking the analysis. So what are the risks of climate change is number one. Number two, how do we reduce our greenhouse gas emissions? So I think there's plenty of instances where the mining sector is basically the forefront of that.
Yeah, I agree. I think 10 years ago it was more about, well, if we could do a hydroelectricity project, we can cut our costs down. Now it's a lot more around, well, we can get our costs down, but it's also a green story, and so it's like we're reducing our carbon. And all the major mining players are well on top of the issues around climate change and carbon, and are ahead of the game in terms of, I think, as I said before, where legislation is or where they are, because their shareholders and boards are demanding it. And then I think if you took it, just all public, but Rio's made a strategic decision to get out of coal, thermal coal, met coal is all sold. And you look at the Rio Tinto ads, they're all talking about, well, we produce, light aluminium that's actually, well, so that's pretty carbon intensive as well. It's a light metal that fuels planes and makes things lighter, and so you can see Glencore coming out, although Glencore did buy Rio's coal, coming out and limiting how much more coal they're going to do, because investors are demanding that there's a cap on how much that they can actually keep doing in coal. So I think the big mining companies are all, and the oil and gas companies who are in the thick of it as well, have to be able to, play within what investors and their boards are wanting to see happen.
Maybe just adding to that, Kevin mentioned some of the great examples yesterday. So Sandfire with Dewey and their hybrid project. Goldfields has mentioned it's almost that 112 million investment for Agnew. I thought some of the other interesting ones I didn't know about was in Holland spoke about Kirkland and what they've done. I think 80% of their fleet, the underground fleet, is battery operated, and that's being driven largely by the ventilation costs, the limitations on ventilation for the deeper underground mines. That makes a lot more sense because it's a cost-driven initiative. Kirsten Rose spoke from BHP yesterday, which I thought was pretty good. In terms of, they're going out to tender for some of their renewable projects. I think it was 6 terawatts for Chile, and it was 200 or 300 megawatts for Australia. And so I think that's driving the companies that are driving that are doing it for the right reasons. It's not just to tick a box, but it's fundamentally because it's also cost driven. Their shareholders and their investors want to see it. And other examples, it's non-mining, but I think they're interesting. We're seeing a lot of, in the property development market, low carbon building. They're driving some of the initiatives in regards to that. Transport, aviation, Qantas is doing some fantastic work. Woolworths for retail. So I think there's more and more examples within the mining sector and even outside that are driving some of the investment and achieving goals to achieve in some of the climate-related goals.
So in the current day, it may make economic sense. Are you asking companies or companies offering up scenarios where they model different carbon prices, for example, and the impact on their cash flows and the project valuation? Is that something that's already in place, or is that something that you can see coming in the future?
I can take a stab at that if you want.
You'd be brave.
Thanks, Glenn. Look, our approach is to allow the company. We're not setting, and we're certainly not pushing a single price. What we're asking them to do is run scenario analysis. Those scenario analysis, just like you would for a typical mine plan where you're running the sensitivities or scenarios on various commodity prices to understand the impact on the business and the plan. The same thing with regards to that is to say, run those scenarios, understand what the impacts are, and again, coming back to whether they're physical risks and manifest in their business in terms of an impact on exports or something, or whether that is in fact a supply risk where it affects their cost of energy. What's the impact to their business and to their bottom line fundamentally? Because we want to understand that risk profile. So I guess that's the approach we're taking.
So moving on to the regulation side of things, can you see additional climate-related regulation coming in the future, and what sort of direction do you think that's going to take us?
Well, we've also mentioned the TCFD, and there are recommendations there fast becoming more broadly adopted. There's already noise from the Australian accounting standards. The ASX Governance Council have released guidelines. So you can just see that there's this continual process of adoption of requirements and reporting, and that will will just naturally over time become just formalised within governance and within regulations. So I think it's still evolving, but you can see where it is evolving to.
Yeah, I agree with that. I mean, I just think it is just happening. It is moving to that degree, and it's just being driven slowly forward through action. I think.
So how do you see the demand for more sustainable products in the future and the expectations of the consumers as well as the investors? How do you see that progressing?
Well, definitely. I mean, the flip side to all of this is essentially what opportunities are there for banks and their customers. So we sort of touched on environmental bonds. That's already something which is in place. Mortgage lending to 6-star rated houses. So essentially, and also looking at basically products that feed into the growth in EVs and so forth. So that there's certainly an increasing interest in those, and also for some companies in terms of how they not only how they run their own climate strategies, but also how the products that they produce, how they can convince banks in the market that those products are sort of cornerstone products that are going to be required as part of the global picture in terms of increasing renewables. So what goes into renewables? There's copper, there's nickel, there's lithium, there's cobalt. So that's part of the story as well, part of the picture.
If I can add to that, look, I think it's a really important question, because I think that's where, and rightly so, banks do look at the risk side of things and the downside, but then there's the upside, which is really how does this represent opportunities for banks, number one, but also, and our shareholders, but also in terms of saying, for clients, how do they benefit from that? Is there a benefit, in fact? And I think the guys have touched on some of that. We've put our own goals in place. I think one of them is to say by 2020 we would commit $15 billion of funding to sustainable development and climate-related goals. To date, I think we've got about $11.5 billion already committed, and that's really in order to try and fund some of these things. Now, again, in terms of green bonds, some of you may be familiar already. We did our first bond in 2015 for about 600 mil Aussie. The proceeds of those bonds then create opportunities for, we've got $1 billion Aussie portfolio that's dedicated to fund renewable projects, including construction for low carbon buildings, etc. So what that does for some of those bonds, it's actually quite opportunistic for our clients, because there's a lot of competition in the market currently. We see that. And as a result of that competition, it means it fundamentally drives pricing lower. So, and not just the pricing, in other cases, for some of these bonds, we see 2 to maybe 3, 4 times oversubscription. So if the guys are coming to the market looking for 300-400 mil, and you could say there's appetite for maybe $900 to $1.2 billion. And what that means with some of our clients is they may do an issuance initially and say, hey, if there's that much appetite, we could actually take, once we've developed this renewable solution, we could do something again in the next 6 to 12 months and pick up where we left off. And similar for the sustainability linked loans. So these are loans that we just done a deal in May, and this is public information, with Sydney Airports for, I think it was Aussie $1.4 billion. Now it's the first of its kind in terms of syndicated sustainability linked loan. What that means, or what that means for potential other clients in this area, is that we agree with the client in terms of them meeting certain climate-related goals. And as they meet those goals, and we can tick them off, fundamentally their margin ratchets down. So there's an incentive that as they meet those objectives, it incentivizes them from a pricing perspective to achieve them. And I think I think that's the right thing. I think it shouldn't just be about compliance and regulation. It should be about trying to encourage the right behaviour and investment.
Yeah, that's right. And essentially, as you said, the funding is actually there, and those bonds, when they do go to market, are always very heavily supported. So that is an evolving market, and it's a way that investors are providing support for reduction of greenhouse gases through lower funding.
Does your organisation have any publicly stated targets or dedicated funds of the same nature?
Yeah, I mean, we do have, we do green loans, we do green bonds. Those criteria have to be met. There's certainly increasing investment demand for those pools of capital because they specifically can invest in something that meets certain criteria to classify it as a green bond or a green loan. So we've got those pools of capital as well, and external investors. There's growing amounts of those pools of capital. On the equity side as well, there's growing pools of capital that can only invest in certain companies that have certain criteria being met. So we're seeing, both certain funds can only do certain things, and that's growing those pools of capital. So, where the capital is also drives the change because, everyone needs the capital, whether it be on the equity side or the debt side. So we're seeing more interest in those pools of capital growing that way as well. So it's being targeted in lots of different ways.
So I've probably asked enough questions. We should give everyone else a chance. So is there any questions from the crowd?
Thank you. Good morning. Emma Harris from Greenbase. Do you see any benefit, sorry, if I may, can I go back to all the reporting frameworks that you mentioned? We've got a number of our clients that we work with at the moment that have literally been targeted by a whole bunch of different frameworks, the TCFD, the CDP, ROBCOM-SAM, you name it. Is there any benefit to answering and responding to all of those, or are they better off potentially picking one and doing that quite extensively? I mean, I'm sure you understand that there's a lot of effort and time invested, and some of the smaller junior miners perhaps don't have the capability to do that in-house. So I suppose, are they better off doing everything, or focusing on, say, a GRI, or focusing on a SASB or the like?
That's actually a really tough question, and I think it goes back to what we were discussing before around there just has to be some sort of framework adopted, which is basically the gold standard, and then everyone reports to that. I guess certainly we're very committed to the TCFD, sorry. And I think I also mentioned another part of the Carbon Disclosure Project. I'm sorry, that doesn't quite answer your question, but it's one of those things that I think the whole sector, and in fact all industry, needs to try to work together and try to resolve it so that there is essentially just one standard that everyone adopts. And that way, that works ideally for banks, for investors, for equity, because they're then able to benchmark everyone against essentially the same standard.
I can have a bash to that as well. Look, I agree that it is a tough question, and I think our approach is we're not telling our clients how they should report. We're suggesting, encouraging is the language we want to use. We've chosen to use FSB's TCFD. We think it's a good standard. We think it outlines all the key issues. You would think that as it gains more momentum in the industry, and I say the broader industry, not just mining and metals, as I mentioned, I think there's already 14 major mining companies adhering to that similar standard already. I think it will gain more acceptance. My thoughts would be, if that is, I'm not saying that's the only one, and that's not the gold standard necessarily for that it's the only gold standard. But I think as it gains more momentum, I expect more companies to follow suit, and hence that becomes more acceptable in the industry.
Up the back corner.
Yeah, thank you for your talk. My name is Barry Ludbrook. I'm with the Public Utilities Office. Paul spoke about climate risk in terms of the physical impacts and the transitional impacts and how that affects the supply chains that the company is facing and how important that was. I'm just wondering whether the NAB and ANZ also take those physical and supply chain risks into impact, and if so, how those types of impacts are comparing with the transitional impacts.
I can try and have a stab at that. Look, let me start by saying, absolutely. So we do look at the physical risks and we do look at the transitional risks. And the physical risk is a broad umbrella, as you'd probably be very aware. So, for example, if you're looking at climate-related physical risks and storm events, etc., affecting farmers and agriculture, there's a knock-on effect, right? In fact, our bank is undertaking a lot of research in geospatial climate risks. Now, if you told the bank that that's going to be a key segment of R&D, maybe 5-10 years ago, you'd say, what's the bank got to do with geospatial risks? But it becomes quite important because if we're funding those farmers and we're funding the sectors, etc., in those areas that are exposed to physical risks, then we want to understand that. And there's a knock-on effect because that affects the insurance companies who may not want to go and provide long tenors for the loans, which will affect our ability to fund some of those things. So that's just an example on the agricultural side. I can take the same analogy, for example, for mining and metals, as I mentioned earlier. If there's a big impact on a big coal port, for example, or an iron ore port, as a result of climate or physical risks, we need to understand that because if we've got money out the door, it's incumbent upon us to understand the exposure that we face. And so those are some of the physical risks that we talk to our clients and that we do our in-house modelling as well, and we get experts to do that. I think in the same vein, we take that sort of a scenario analysis into the transitional risks, which is really about transitioning to this lower carbon economy, and that's probably a very big segment as well, to understand how does that in fact affect their supply and maybe even their export market. Because you can imagine if, for example, what we've done is we've divided our whole analogy on physical risk and transitional risk into different segments, whether it's direct emissions or indirect emissions. And so an indirect emission, for example, could be a steel company that has indirectly got exposure to thermal coal that it uses in its blast furnace. So we want to understand what's their thinking, how do they evolve, how do they mitigate those risks?
Yes, I mean, it's certainly a factor of understanding the entire chain. So essentially, what a particular company is doing, how the supply chain works as well, and it even goes. So our ESG team even drills down into social issues through the supply chain, and then how is that product used? How it is exported and transported? So I think that's effectively that's something that happens now. So as part of our ESG assessment, it's really the entire supply chain.
Probably have time for one last question, if anyone has a burning question.
I actually have a question. I wanted to pick up on what Grant said, which was really interesting about the credit risk analysis and running the scenarios for carbon pricing. And I wonder if you have a mine that has taken action by investing in renewables do you then reduce that risk? So I guess I'm sort of asking, is there a direct correlation between investment in renewables or other carbon mitigation actions and credit risk, or lowering credit risk?
Yes, there is, certainly from our side. So when we look at risk again, risk is a huge umbrella. There are different aspects to that risk. There's financial aspects, there's project-related aspects, and again, the question would be: is that a project financing that's a very isolated risk, or are we talking about at a corporate level that we're funding? Because then that's quite different in terms of how we assess those risks. But yes, I mean, in order, again, to incentivize our clients, not just by the pricing mechanisms directly, which is a function of, as I mentioned previously, the sustainability-linked loans, but to incentivize our clients to proceed with some of these things, it affects their risk profile. And for those who don't know, that risk profile affects our funding costs, right? Because fundamentally, as a company's risk profile decreases, in other words, becomes riskier, our cost of capital goes up. Why? Because we've got to report and adhere to APRA, and as the risk profile of default increases, we've got to allocate more capital, which means the margin goes up. So absolutely, the fact that if you go and you then invest in some of these initiatives, it would stand to reason that you would then reduce your risk profile. Your credit risk should improve, and as a result thereof, you should see an improvement in the pricing and the margin.
Yeah, I suppose just a bit of that. So our ESG team is part of our credit risk team. So it's part of the credit risk process for a new customer and for reviews. And then I guess as Grant was saying, that there's certainly going to be increasingly a correlation between ESG risk, which is, sometimes might be binary, it would be approval or not, and also pricing.
Please join me in thanking these gentlemen.